Hey guys, and welcome back to the channel where your commentator actually trades, unlike most of these other YouTube channels where they just like to play around with charts on their paper trading accounts. But anyway, we've had a down day today, down moderately. The SPY actually gapped down 1.46% and then just waved up a little bit to finish only down 1%. Same with the Qs, we actually gapped down 1.8%, sold off, and then just kind of held in a bit of a sideways pattern with a little bit of late day buying. I came in today flat, market neutral, equal amount of longs and shorts, and actually finished the day down a bit. I'll let you know, stay to the end of this video. We'll go through all the charts and give a bird's eye view for you of all the markets and important themes going on. We'll go over some data as well, what's going on in the market, and then I'll let you know how I'm finally positioned going into the weekend. I think you'll find it interesting. So let's just switch back over to a daily chart here, and you can see we've now, Qs have gapped down below their 50 bar VWAP, and the SPY, this trend line that we've been watching since we put in that huge bullish engulfing back on the 13th of October, I'll never forget that day. We have broken down that trend line, and the market's just kind of sneakily selling off. It's just gapping down and holding, but we're still making lower lows and lower highs, but we have not had that big flush yet. So let's just go take a look at the heat map today. So you can see overall it's kind of similar theme all week. We haven't had that blanketed breadth across the markets, so we're mostly red today with tech, communication, healthcare, and cyclicals and real estate. However, financials, utilities, and energy has held up, and we've had a big important piece of data came out today, and that was the personal price index, Personal Consumption Expenditure price index, which is the Fed's favorite measure to see how prices are moving in the country, and that came in a lot higher than expected at 5.4% year over year, and month over month 0.6%. So all the signs of inflation are still there. I mean, we've got CPI, PMI, retail sales, jobs, all confirming inflation is still well and truly alive. And if you look at this, the market is actually starting to price in a 30% chance of a 50 basis point hike on the March Fed interest rate decision, and that's up from 18% a week ago. So we're moving up big time in rates and inflation, which I'll get a bit more into, but let's just go back to the charts, and we'll come back to this in a bit. So we're back on the daily chart here, and we'll just go through all the markets. You can see there was a bit of negative bearish breadth in all the indices, especially in international. Now we've now got all international indices under their 50 bar VWAP. So Australia, Europe, Japan, and China especially. But volatility is still just not really bouncing out of here. The market, and we're well overdue for a rip up in VIX. You can see we've going back here. We last peaked in October when we bottomed on the 13th, and we just have not had a decent upswing in volatility. There are a few more people buying puts. We can see the put call ratio at 111. And just look over at some breadth charts here. We'll just go to a 3-day chart, and this is the amount of ETFs making a new high on any given day. And you can see back here in the bull market that started after COVID in 2020, that really trended higher. Same with NYSE new highs and NASDAQ new highs. That just trended high, which is something you need to see a structural uptrend in this for a bull market. We've just not had that. We just keep coming up and falling over. So this is way too early to call this a new bull market, as a lot of people out there are. And let's just go over to the spread charts. So we're looking at the high growth cyclical versus defensive sectors. They were down today, but we still haven't had a flush, and they're still above their 50 bar VWAP. High beta versus low volatility just came off today below its one, but his growth versus value still just having a slight pullback here, and tech as well. Did have high yield come off today versus treasuries, but check out this. Look at the 2-year rate. That is ripping, and the 10-year as well. And look at Fed Fund futures today in September. We got as high as 5.44% today. That's the market. The sophisticated, well-educated, lots of good data bond market saying that there's a chance we'll be seeing 5.44% from the Fed in September. And look at December, new highs again today. You've been hearing me on my channel saying we are walking the line, no signs of stopping on this. Rates are just marching higher. Forget about Fed pivot and dovish and cuts. That's just not happening anytime soon. And with that, treasuries are sold off, and high yield, which we've been watching as a key indicator for risk sentiment, that has gone back down below its trend line now. And let's just go back and look at some more data. We can see here stocks are still very overvalued according to their 10-year PE. You can see back in the 70s when we had inflation, the valuation of stock just marched down until inflation peaked. So higher inflation, uptrending inflation, is not good for stocks because rates are going high. You can get a much safer yield from the government than in stocks, and we're still high up here around 28. So this is starting to really disconnect with rates. And look at this cap rate on rental properties versus the 1-year treasury yield. So 1-year treasury is now over 5%. Versus the cap rate of about 4.6 on average rental property. So you can, I don't know about you, but I'd rather rely on the US government to pay me a 5% yield than some tenants calling me at midnight because their fridge is broken or something like that. So we've got a huge, starting to see a gap now between the yields in bonds and other growth assets like real estate and stocks, but we've still got the fear and greed index at 59. This market has not flushed out yet. We need to start seeing this down in 30 and fear or extreme fear level before we can start saying this market has had a good flush. And the dark index measures dark pool buys. They've started to roll over as well. Okay, so back over to the charts. So we had been looking at the SPY as potentially pulling back here yesterday. If you watched my channel, I just wasn't too sure. The price action was looking like we could have pulled back, but I wasn't so sure. That's why I came in market neutral. But today I've started feeling bearish again, but we'll come back to that. Let's just keep going through the charts. We've had the dollar move out. Look at this. We've been saying here this is in a bull flag, and that's just broken out today. We do have a bit of overhead resistance zone to get through, but this is bearish for equities and risk sentiment in general. And oops, look at this, Bitcoin down 3.2%. If you've been watching the channel, I've been saying we've been looking like we're having a top here. So this is a big time risk sentiment indicator, and that is rolled over. Moving on, let's go over a look at the commodities complex. Commodities actually put in a bit of a hammer formation here, and we can see we're down at this support zone, which really needs to hold for commodities to keep their long-term uptrend, but it's got a higher dollar flying in its face, so that's a headwind for commodities. But there is a lot of tailwinds fundamentally for commodities, so we could be holding here. We'll keep an eye on that level going forward. Dr. Copper, down 2.3% below its trend line. Copper's big leading indicator of future economic activity because copper is just used in so many products and industries around the world. So that's not a good sign for upcoming economic activity. Gold has still yet to find a technical bottom. We've got, the higher dollar is causing this to come off and doesn't look like it's found a bottom yet. Natty gas had a pop today. It's doing its own thing. And today I thought I'd do something different with going through the stock sectors. I thought we'd look at it on a weekly chart just to give you some, bigger perspective of what's going on. So we'll switch over to a weekly chart. And then we'll switch on our trend candles indicator, which allows you to easily see what sort of trend we're in. So this is the IPO ETF. And I'll just go through them all for you to see overall where we are in terms of the sectors and their long-term trends. So this is ARC, clean energy, tech, discretionary, semis, bots, communication, retail, biotech, energy. Look at the difference in energy compared to the others. oil and gas as well, materials, gold, financials, regional banks, industrials, transport, real estate, home builders, which had actually gone bullish, but I've been fading this move. If you've been watching the channel, home builders should just not be up here, in my opinion. Airlines, with their structurally damaged balance sheets. Defensive stocks, which you know I'm bullish on. Look at that, breaking out. Healthcare, which has still managed to keep its bull trend. Consumer staples and utilities. Okay, so you can see overall we're still overall bearish in most of the sectors and all the growth cyclical stuff. So one could still call this a bear market rally. The overall long-term trend is still down, except for energy and defensive stocks. And technically, home builders has gone bullish, but that's a signal I'm fading. Moving on to popular stocks, BlackRock Barometer, and why I call it the BlackRock Barometer is because BlackRock's success is based on how much money is coming into the stock market, because they manage so much assets under management. And of course, you know, insiders and fund managers and everyone close to them know what's going on. They can see all the data before everyone else, and they are selling this off. So this doesn't look to be bottoming and trending down. So that's not good for funds coming into the stock market. And look at this, all the big stocks, a bit of bearish breadth today. Apple's come off, still above its 50 bar. Microsoft just gone below it. Amazon's looking really weak. Google still can't find a bottom, but we're coming down to this support zone where I think it could find some buyers, because we'll be start to looking good on a cash flow valuation basis. Meta just kind of sitting there. Nvidia's come off, and we had that big pop yesterday, and if you're watching the channel, their earnings and revenue are actually down a lot year over year, but they did mention the word AI a couple of dozen times, which the market loved, which tells me this AI thing, you know, has got a lot of attention. But is that a reason for a big structural uptrend after this move, just because they said the word AI 20 times? I'm not sure about that. Tesla, bit of a crossroads here. You saw me yesterday put in this trend line. We've just come to it. It's been a bit dip port, like it always has. However, let's draw a market profile from the bottom till today. It's right at its point of control. So a lot of people that are long from this move are now sitting around break even. So you think about market psychology. There's a lot of trend in the stock, as you can see from the range strength. This thing is moving. So market psychology is people are sitting around break even here. They're thinking, oh God, it got up here. It was just good. I was hoping it was going to go to 230, 250 and maybe get out for a good gain. If we start breaking this trend line, start getting away from the point of control, that could cause a bit of a waterfall, and I expect we could come down to this 50 bar VWAP very quickly, maybe in just a few hours. And then we'll see if we support there and hold that earnings gap, which I do expect it to. So Tesla, don't be surprised Monday or someday next week we got a good 5, 7, 8% down day, because this is, you know, there's a lot of heat in this thing. So we'll keep an eye on that. Meme stocks were off today, except for Beyond Meat, which actually reported good earnings, better than expected by a little bit. But the market took advantage of that high price and sold it off. Carvana was down 20% today. And GameStop. Boeing today, they had a bit of problems with their products that they stopped. Some negative news came out that sold off. Block actually jumped after their earnings, and Adobe looks like the government's going to block their Figma acquisition deal, which the market did not like. Okay, so back over to the markets and what we're thinking going forward. Okay, so I was yesterday thinking this could be a pullback. You know, we had the tails there on the trend line, but we've broken down that today, and the market's just kind of putting this sneaky price action of coming down, but not in a such obvious way. And we have not had that flush yet. So that the biggest Monday was the biggest down day so far this year, just at 2%. Not really big. We haven't had that big 3-4% down day in high growth. Same with the cyclical sectors here. We just haven't had that big flush out from this rotation into growth yet all year. But I just can't ignore these rates. The stock market is just going to have to price us in at some point. The dollar climbing as well, looking so bullish. Rates looking so bullish. High yield now is starting to trickle down below its trend line. All the ingredients are there for a big flush out in the market, especially with the Fear and Greed Index still in greed level. So I just can't ignore that. Even though volatility is just not popping up, we've got a lot of just negative breadth starting to form in the market, and we are still in long-term downtrends, as I just show you. And with the job market tight and stocks moving up, that gives the Fed permission to keep its foot on the gas. And we've all heard of the Fed put, coming to the rescue when things get bad. But what about the Fed call? And that's the Fed. They're worried. Their risk is to the upside. They've got to get a hold of inflation. And with a healthy stock market holding up and jobs, the only reason Jay Powell will pause on his rate hikes if a lot of people start losing their jobs and things start looking, more bad going forward for the consumer. But right now, it's healthy and prices moving higher. So I would not be surprised next month, which I just find it hard to see the stock market continuing higher in the face of that. So with all that being said, came today market neutral. I should have been short. And I've actually tilted the portfolio 100% net short, which is pretty aggressive for me going into the weekend, as I normally don't go so strong tilted. But I'm swinging for the fences here. I'm going for a flush. I could be wrong, but I'm just looking for that 3-4% flush in the market, and for the stock market to finally recognize what's going on in the rates, Fed fund futures, which is just undeniable, this price action here. So that's how I'm positioned. We'll see what happens next week. And thanks for tuning in. I appreciate all you guys' support, liking and subscribe. And I hope to see you on Monday afternoon, and we'll discuss the price action then. Have a good weekend, guys.